The stock market is about to go crazy, and what we need to do is dig into what's going on in bonds, the US dollar, and with Fed. Because what happens with these three variables will tell us if the bears or the bulls are going to come out on top. And by the way, if you're wondering where I got that image for the thumbnail, it was actually created by the AI in the Discord, and this thing makes some crazy images. I mean, this guy has two sets of bottom teeth. I put stock investor going crazy. I think there's an arm growing out of his bicep. It's like, the more I look at it, the more creepy it gets. But enough playing around. It's time to actually dive into these issues one at a time. And the best way to start is to talk about what's going on with the Fed, what just came out in the Fed minutes today. And to do that, I actually want to bring up an article by Tyler Durden. And if you want to read this article on your own, there's always going to be links to these in the Discord. Anything I talk about on YouTube and much more information is going to be in the Discord. And the big thing to keep in mind is that Fed minutes is usually just a summary of what we've already heard at the FOMC meeting, and they're not the same. And so usually you'll see that the Fed minutes is just a reiteration of what we already heard. But instead, this Fed minutes seem contrary to what Powell came out and said just the FOMC last week. And so what usually causes the market to have more certainty instead led to a bunch of confusion. And you could see that in the price action of the SPY. Even the algorithms didn't know which way to send the market. And because of all this uncertainty, we melted down into the close. And there's a lot of different things to pick out here. Overall, the Fed minutes seemed more dovish than the last one. Now, Powell at the meeting said that the financial conditions hadn't changed much, even though there is obviously a slowdown. But in the Fed minutes, they actually recognized this, but they still said that they need to hit their target. So the blue line here shows you the financial conditions, and the red line here is the target we want. So we want to continue tightening until we hit that target, and there's still a long way to catch up. And if we also look at how many times the word pause, as in a pause in rate hikes, was used in the Fed minutes, it was only mentioned once, and that was in reference to other central banks. So even though the Fed minutes were overall dovish, we can see that the market's expectation of a rate cut this year has actually collapsed, and that it's overall more hawkish, which I think is even better represented when you look at the expectations of hikes in March, May, and June, all the way out to June. And remember, on the last hike, people were saying, oh, this could be the last one. And now we're having expectations that we're going to continue to hike on financial conditions even after recognizing that the economy is slowing. And this has definitely caused some chaos in the market. And one of the big things to keep in mind that I was talking about in the live stream is we've had a lot of surprises actually to the upside. Even though the Fed recognized that there are some financial conditions that are definitely coming down, there have been multiple surprises to the upside, especially when it comes to manufacturing, which brings with it also the fear that inflation could be persistent and sticky and come back, which is why the Fed is saying, okay, maybe we need to continue tightening all the way out until June. Maybe there will be no cuts this year because they want to bring the economy down to make sure inflation is gone and not coming back. And even though I would love to not have to pay so much attention to the macro, this story is not going anywhere. The Fed has actually admitted finally that they don't expect to get back to their 2% target until 2025. So now that we have all this data put together and some of these variables filled in, we can now have a better depiction of what's going on with DXY. And remember, this is US dollar futures, and we can see that it seems like we're breaking out of this downtrend and we're having this pretty dramatic reversal with the US dollar futures, with a nice rise coming right at the beginning of February, seemingly in trend with these rate hike expectations. Because remember, if we continue to tighten, the dollar will continue to strengthen, and this is when all the world's central banks are still easing or pausing. Now, I'm not going to reiterate the global macroeconomics that occur in this type of environment, but if you do want to deep dive on that, go ahead and watch my old video, Is the US Dollar at Risk of Collapse? In this video, I'll do a big historical analysis and talk about what is known as the dollar milkshake theory. And for quick access, I'll link it down below. And it's important to have that information so that you can make sense of what's going on with the SPY. You can see that we had the sell-off at the end of the day, but VIX doesn't seem to be reaching a new high, even though the market reached a new low. And that's because of what's going on with DXY. The dollar is going to be a wrecking ball on the markets if it continues to rally up. And it's also going to spell lots of trouble for China as well. And to better explain that, I want to play this clip from a macro analyst who I think did a great explanation today on Real Vision.
A strong dollar has the potential to kill multiple birds with one stone, meaning that one, it is legitimately fighting domestic inflation. But number two, right, it delivers asymmetric burden on our primary geopolitical adversary. Because the big tell to me, so you would think, right? You would think that China, being an export-driven economy, would want a weaker yuan. You would think that they would welcome, right? But to me, the big tell that they have other issues that they're worried about, meaning capital flight, is that when the dollar really spiked in, I believe it was Q4 of last year, right? Q3 and Q4 of last year. What did the PBOC do? They intervene to actually strengthen the yuan, right? When you would expect them to welcome a weaker yuan.
So for those of you confused, let me catch you up a little bit. China has been trying to support their markets using their central bank, their version of the Fed, right? They've been printing lots of money. A great way to do that is to create a weak yuan. But we can see that China is so worried about money leaving the country and going into investments in maybe the US even, that they are strengthening the yuan instead to try and keep money inside the country, which is counterintuitive to them actually supporting their markets. And this is important for US markets and for a lot of you who probably have 401ks, etc., that are invested in emerging markets like China. Those assets could be in a lot of danger right now because China's going to have a tough decision if the dollar continues to rise. On top of that, if oil prices also have a spike, which I expect to occur eventually, now of course the economy's slowing, that will keep these prices suppressed, but in the long term, there is a huge fundamental case for us getting another spike in energy prices. If China has that combined with all the issues they're doing right now, they're not going to be able to support their markets. And on top of that, they have tons of short-term debt. They actually have the most short-term debt in private markets than the rest of the world, even more than us in the US. And we love our debt. And what is the climax of all of that? Well, if you know the dollar milkshake theory, you know that that usually leads to money pouring into the US, which could cause a huge ramp up in the US stock market, which means despite all this bad news that seems very bearish, the bulls could still come out on top. So what do you need to be watching to get a better expectation of how much the Fed can actually hike? Because remember, the Fed is very frequently wrong. And in fact, we had a dollar milkshake theory last year that didn't play out. And instead, we got a relaxation in that global financial crisis. Didn't seem like it was going to play out. Well, that answer is going to be the bond market. Now, bond market is huge because these are more sophisticated traders. There's so much that you can garnish from the bond market due to the fact that these traders only watch two things, and that is growth and interest rates. It's the only two things they watch. Therefore, they tend to be much better at it than the actual stock market. And they were flagging actually the turnover that we saw in the market that occurred recently. You know, equities lagged what occurred in bonds. And if we look at the short-term price action of the bonds, we can see some of the levels I've set here. I had a hard cut at 103 because I said if it drops here, I'm going to be looking for 99. However, I did overlook how pivotal this 101.30 mark will be for bonds. You can see that this was the bottom all the way back to 2014. This is where we had a bottom before we rallied back up. And it seems like the market has actually found some consolidation here and has managed to hold this level, which means that bonds are at a very pivotal point. If you see a further meltdown from here, it could be the bond market telling us, hey, we're giving up. The Fed's going to keep hiking and they're going to be able to keep these hikes up. At which point I would be looking for a visit all the way back down to this previous low that we saw earlier this year. But if instead we get a rally, that could be the bond market saying, we don't believe the Fed. We don't think that you're going to be able to continue hiking, and we're actually going to start pricing in a rate cut later this year. But even then, I still like my bond position. I said I cut earlier, and I should have been more specific that I cut an option position that I had, some more shorter term options that were dated out till June, which now with the Fed minutes coming out, looks like it was a great decision because those premiums and those contracts have probably been smacked around a bit with the new expectations that have come through. But if we look at this chart right here, pretend this isn't bonds, pretend it's something that you actually find interesting, pretend it's a stock, because I know most of my viewers are younger and they don't care about bonds. They probably haven't even reached this point of the video because they zoned out. But if you're still here, pretend this is a stock chart, right? And you bought it at the IPO. How much have you loved holding this? All the way up here? And let's pretend you love this stock and you see it dip all the way here. What are you doing with that? you're buying it, right? So even with this volatility, even with the fact that this could revisit the lows, I'm looking at TLT right now and saying this looks like a fantastic buy opportunity. And we could see just how oversold it even got at those lows. I think that bonds could end up being the trade of the year, or maybe over the next few years, if the Fed's plan actually manages to play out, which I don't really have a really high expectation of that. But if we come back to 150, what you're getting a 50% return here. Maybe you take 20% burn in the short time. That gives you some more time to DCA, the dollar cost average into your position. I mean, it just looks wonderful from there. And so I think that right now, if you're starting to learn macro and you're looking for a way to turn that macro knowledge into actual returns on your money, the bond market looks like a great way to do that. And that's going to be it for this video. If you made it all the way to the end of this video, comment down below and say sign me up, and I'm going to give you a free 1-month subscription to the Discord because you're awesome. This is a complete knowledge dump, and I think a lot of people are going to completely zone out on it. But if you watch all the way through, it means that you've got some commitment to learning that, and I would like to reward it. So comment down below, and I'll see you on the next one.